Okay, every single day, trillions of dollars change hands, right? And it's all driven by these invisible forces dictating the rise and fall of stock prices. So in this explainer, we're going to decode exactly how markets actually react to information.
Look, have you ever watched a company announce just absolute record-breaking profits only to see its stock plummet the very next morning? It's a paradox that kind of baffles everyday investors. You sit there thinking, wait, they made billions. Why is everyone selling? Well, it's not random. The answer lies in the hidden mechanics of how financial markets process new information. See, it's not actually about the news itself, but how that news fits into a much, much larger puzzle. To figure this out, we'll quickly run through the market as an information machine, look at how reactions are measured, dig into the classic earnings surprise, track the insiders, and finally reveal the real culprit, the expectations game.
Right, so part one, the information machine. We first need to look at how the market is supposed to act when it's functioning as a giant calculator. This brings us to the absolute bedrock of modern finance, market efficiency. So in a perfectly efficient market, the price you see on the ticker, that is the best possible estimate of a firm's true value at that exact second. It basically assumes the market is a giant supercomputer instantly aggregating every news article, every rumor, all of it. If this theory holds up, trying to outsmart the market is pretty much a fool's errand. You literally can't find a bargain because true value has already been priced in before you can even hit refresh. So in theory, the reaction to new information is violently fast. The second positive news hits the wire, bam, the price adjusts instantly to the new reality. No debate, zero delay. Imagine a company announces a huge breakthrough patent. Within milliseconds, algorithmic trading bots have already bid the stock up to its mathematically correct plateau. That's the textbook ideal anyway.
But human beings aren't supercomputers. Reality actually behaves a bit differently. A lot of times, the market acts more like a slow learner. Instead of this instantaneous spike, the price gradually drifts upward as the news is digested by the masses, talked about by pundits, and finally acted on by everyday investors. And this slow drift, it's the holy grail for information traders. It creates a brief, incredibly lucrative window to grab excess returns before the rest of the market catches up.
Okay, part two, measuring market reactions. If the market is constantly reacting to all this information, how do analysts actually play detective and measure these invisible shockwaves? Well, they use a highly structured methodology called an event study. Think of it as isolating a financial variable in a petri dish. First, they pinpoint the exact day a major event hits, like a surprise dividend or a huge merger. Then they draw a strict boundary around that date, an event window, and meticulously collect the stock returns. Crucially, they strip away the overall market noise and macroeconomic risk. By the end, they can mathematically prove whether a specific headline actually moved the needle, or if the stock was just bouncing around with random noise. Moving on to part three, the earnings surprise. Let's look at one of the most reliable market movers out there. It's a really common misconception that an earnings report is just a report card on the past. In reality, it's a telescope looking directly into the firm's future business model. Take the year 2000, right in the dot-com bubble. Tech darlings like Ariba saw brutal drops in value immediately after their earnings came out. The numbers showed they were fantastic at driving web traffic, but terrible at actually generating sustainable profit. So the news wasn't just bad math for that quarter. It fundamentally shattered the market's long-term expectations for their survival.
And when you look at the data around earnings, human psychology is just glaringly obvious. Companies are notorious for what we call the Friday data dump. If executives have terrible news, missed targets, regulatory issues, they purposely release it late on a Friday afternoon. They're basically crossing their fingers that investors will be too busy thinking about the weekend to notice. Unsurprisingly, the data backs this up. Excess returns on Fridays are starkly, predictably negative. It's a classic game of corporate hide-and-seek. The timing communicates just as much as the numbers do. When a company announces its earnings early or right on schedule, the market perceives confidence. But if a firm delays its report by more than 6 days, alarm bells start ringing immediately. The market intuitively knows a delay almost always means accountants are scrambling to package bad news. This triggers a sharp sell-off before a single official number is even released. The delay itself is the information.
Part four, following the insiders. To truly understand market reactions, we need to look at the people operating right at the nexus of private data and public knowledge. When we evaluate Wall Street analysts, a wild asymmetry pops up.
An analyst issues a buy recommendation, and it triggers a quick, optimistic 3% jump in the stock. Nice little bump. But a sell recommendation? Catastrophic. It triggers an almost instant 4% drop, followed by an agonizing, months-long downward drift. Why the difference? Loss aversion. The market punishes bad news way more harshly than it rewards good news. Fear is just a much stronger motivator than greed.
And what happens when insiders announce how they're spending the company's cash? Well, the market loves long-term thinking. Pouring money into R&D or joint ventures generally gets a solid positive reaction. But here is the shocker. Markets actively punish a staggering 55% of all corporate acquisitions. Why? Because history tells investors that executives often have huge egos, and they almost always overpay for a shiny new target company. The market instantly subtracts that overpayment the moment the deal is announced.
Which brings us to our final section, the expectations game, the true puppet master behind these seemingly irrational swings. Basically, as a company's value becomes more dependent on its future growth, expectations become the absolutely critical determinant of how its stock reacts to news. The market isn't just grading a company on the black and white facts in a press release. It is constantly weighing those facts against the massive invisible weight of expectations already baked into the share price. If a stock is trading at a huge premium, the market is already assuming perfection for years to come.
This mismatch between reality and expectation creates those violent swings in value. Think of it like a giant seesaw. If a company is universally hated by Wall Street and everyone expects bankruptcy, a tiny sliver of decent news can send the stock rocketing upwards just because expectations were literally sitting on the floor. On the flip side, if a darling tech stock is priced for absolute perfection and they miss their target by a single penny, they watch their stock violently crash. The news wasn't objectively bad, but the illusion of perfection was broken. So understanding this gap between reality and expectation is the absolute key to decoding the information machine. It completely explains why record profits can still trigger a sudden stock collapse. The profit was great, yeah, but the expectation was even higher. So the next time a major financial headline breaks, you really have to ask yourself, are you reacting to the news, or are you reacting to the expectations hiding behind it?